Hey, I'm Scott Cole, and I wanted to take this time to provide a little bit of a commentary for the stock market after this past week's action. Looking here at a daily chart of the S&P 500, I'm going to bring up a weekly. On the weekly chart for the S&P, we were up about 0.3%. Just under 4 points for the week. For the Dow Industrials, we were down 5 points for the week. For the NASDAQ Composite, we were up 12 points for the week, or 0.4%. For the Dow Transports, we were up 0.4. We were up 21 points. And for the Russell 2000, we were actually down 3% for the week, over 24 points. Now I want to look at the S&P again and look at a week or a daily chart. What I'm seeing in the market right now is it's having some difficulty making much progress to the upside. And I think we're starting to exhibit some signs of weakness, and I wouldn't be surprised to see us run into a corrective period here in the next few weeks, if not sooner. Now, one of the ominous signs that I'm starting to see is some distribution. For instance, one of the heavier volume days in the last couple of weeks, although not tremendously heavy volume. After we had this big upside day here, the next day we closed higher on higher volume, but the range was very narrow. That suggests that there was some selling going on too that was keeping the market from making much progress to the upside. Then as it began to progress higher, the volume started to diminish a bit. On this down day here, where we had a bit of a reversal after we got through 13,000 on the Dow, the market reversed. The volume was actually the highest it's been in about a month. And then yesterday, the volume just dried up completely. So I see a little bit of distribution going on here. It looks like some market participants are taking some chips off the table. Now, there's some ominous signs going on as well with some of the market averages. Okay, so this is dating back over a year. Obviously in the S&P, we've made new highs going back a few years. Dow Jones, I believe we're at the highest level since 2008. Look at the Dow Transports though. And the ominous thing with the transports is they look like they've topped out and we're getting ready to start. We had a little leg down here, and it looks like if we break down through here, we're going to have another leg down. The third leg down in any move tends to be the biggest leg down. So if we break through this level here at about 50.90 in the transports, I would say we're going to be testing a level of 47.50 at first and then 4,500. If we're going to have a correction of that size, then you can expect that the Dow is going to pull back at least 5% from here. And, if we penetrate those 4,500 levels, we might go down to the October lows. Russell 2000 was down 3% on the week. It's another average that has not exceeded its 2011 peak, while the Dow and the S&P and the NASDAQ have been doing so. Now it's clear that the S&P and the NASDAQ are being carried by such stocks as Apple and by Priceline. But we're not seeing the same kind of moves in the smaller stocks. So the smaller stocks are getting ready to start a leg down here. We've broken some near-term support, and the trading on Friday is particularly ominous since it was down 1.5%, and we broke through. We're now trading at the lows going back for a month. So the Russell appears to have topped out. I want to bring up a chart of a cyclical index. This is the Morgan Stanley Cyclical Index. I'm going to put this on a weekly screen. This index is basically an index of economically sensitive stocks. So you can see it peaked in 2007. We had this big down move, obviously, in the bear market. The rebound since 2009 to the highs in 2011. Those highs have not been exceeded since we had this correction here late last year. They're not even close. So what we've got here going on is, at this point, it looks like a massive double top. And in the right side of that double top, we have a formation that could end up being a head and shoulders top. If this this index decides to roll over, if economically sensitive stocks roll over from here, and we end up breaking down through there, then you can bet that we are in another recession. So this is, you can even see it better on that chart. This is kind of ominous here to me. It looks like we've run out of gas in this move up. We're starting to form a wedge formation here where the upslope line containing the lows is at a greater rate than the upslope line for the highs. Usually we break down from there, we're going to get a leg down. So that's some worrisome issue. One other thing I'd like to comment on is the advanced declines in the NASDAQ and the New York Stock Exchange. My moving averages that I use, the short-term moving averages, are below the longer-term moving averages for the advanced declines in both of those exchanges. And what I'm saying is the moving averages for declining issues is going up. The moving averages for advancing issues is going down. And that's also the case with the longer term averages that I use as well. So there's some definitely, I don't know if this is just your pure sector rotation or what, but it looks like this market is starting to run out of gas. I would suggest that the oil market is probably playing a hand in that. It's basically been running in tune with the overall stock market, except it hasn't exceeded its high. But if oil prices continue to trend higher from here and gas prices are going up, that would put pressure on the economically cyclical stocks, and they're going to break down. So it's time to be cautious. I would say if we get a true selling day here soon, where all the major market averages are down at least 1%, that should be an indication that you should raise substantial cash at that time. I would say at least a third. And if you're leveraged at all, then you're going to need to get out quickly. So I would suggest that this correction is going to happen quite rapidly when it does occur. The trends are still up in the major averages, except for the Russell. The Russell appears to have turned down. So the soldiers are starting to flee the scene. So I would trade with extreme caution if you're focused on the long side here. And we'll see you down the road.